I had a client 2 weeks ago who got her first mortgage statement after buying a house 2 months ago, which we helped her buy, and she called all in a panic. I felt terrible, and she's letting me tell you this, so maybe you can learn from her panic. And then she got her first mortgage statement, and it was like 50% higher than what she thought it was going to be. And I'm going to tell you why, and why that happens more often than I wish. Hey, thanks for coming into this week's episode of the Real Estate Minute Show. So back to my friend who had the bad event of getting a mortgage statement that showed it a lot higher than it is. So here's the deal. When you get a mortgage and you see the interest rate, a lot of buyers focus just on the interest rate, 2.85%. I mean, we have historically low rates right now, but 2.85%, sometimes 2.65, but let's use 285 as an example, okay? And let's say you're borrowing $100,000, okay? You do $100,000 times 2.85%. Holy smokes, that's my really low mortgage payment. Excellent. But when the mortgage actually comes, there's another component that most mortgages consist of, and that is the principal piece that you're paying. Unless you have a loan that's going to be interest only, which are kind of rare, but if you have an interest only loan, then you're just paying interest. But if you have a regular standard principal and interest loan, as they call it, P&I, you may have heard those terms, that P portion is the principal, and a lot of buyers forget about that, so they just focus on the interest rate. Now, the lender is going to take the mortgage. That P is made up of the principal amount of your loan, $100,000 potentially in this example. Okay, the lender is going to take that and amortize it over the entire term of the loan. Regular loans are like 30 years, maybe it's shorter, maybe longer. Okay, and they're going to come up with a monthly payment on that. That little extra piece of principal actually amounts to about another 1 to 1.25%. So instead of paying $285, you're paying close to $4. So you could see why my client was shocked, right? It's almost 50% higher than what it was. Now, albeit that principal piece, remember, it's not interest that you're just paying and it goes away for borrowing the money. That's actually like equity in your house you're taking and you're just putting it into the other pocket. You're just paying your equity back. And I can get into that a little bit more if you want to reach out to me. I can explain that to you. But don't forget about the principal piece. I don't want you to get shocked like my client did a couple weeks ago. It's hard. I felt bad for her, but, we explained this all in our buyer, presentation to her and, kind of counseling. And the lender also did for sure on various calls because she's very cash sensitive, so we're very certain. But when it actually came in the figures, a lot of times buyers just forget. I don't want you to forget, which is why I'm telling you this. Bonus tip, by the way, big bonus tip. Most buyers also don't understand that the mortgage interest is actually paid to the lender in arrears. And what I mean by that is you don't pay mortgage interest to your lender until after you borrow it, which is why if you notice sometimes if you ever close on a house, and let's say you close August 15th, and the lender makes you pay on your mortgage statement like 15 days of interest before you close in August, but there's no payment. For some reason, you don't get a mortgage statement for the month of September until October. And you're wondering, God, did I just get a free month? Did they forget something? They didn't forget anything. Okay, lenders never forget anything. So the money that you're paying in October is actually in arrears for when you borrowed it, okay, in September. If you'd like to get into more detail on that, I can get into amortizations and all that kind of stuff. I'm happy to talk to you about it. I love that stuff. Anyway, have a great week. We'll see you next week on the Real Estate Minute Show. Take care. Thanks.